With all the talk about new tech like AI completely changing the game, it's natural to wonder, hey, how do I actually protect my financial future? We keep hearing this term AI inflation, but what does it really mean? And more importantly, how do you keep what you've worked so hard for safe? Well, today we're going to lay out a really clear framework to do exactly that. Let's dive in. So, first things first, we have to pinpoint the real enemy here. Because if you look past all the noise and the headlines, there's a force that is quietly, day by day, eating away at your savings. And believe it or not, it's tied to policies that have been around for a long time. And that force, well, it often kicks off with something called quantitative easing. I know, it sounds super technical, but the idea is actually pretty simple. It's just a way to increase the amount of money flowing through the economy. But think about it. When you suddenly have a lot more dollars chasing the exact same amount of stuff, the value, the actual buying power of every single dollar you have, starts to go down. And that, right there, leads us straight to the inflation threat. The best way to think about it is like an invisible tax on your money. You never get a bill in the mail for it, but you absolutely feel it every single time you go to the store. So here's the bottom line, and this is so important. If your money is just parked in a regular savings account, earning practically zero interest, and inflation is humming along at, let's say, 3%, you are actively losing purchasing power every single day. It's not just that you're not making money. Your dollars are literally buying less than they did yesterday. Okay, so how do we fight back against this? I'll tell you right now, it's not about scrambling to find some hot stock tip someone tells you about. No, it's about a journey. It's a process of actually developing a new skill set. It's about moving yourself from a place of ignorance to a place of proficiency. And I absolutely love this quote because it just makes the whole thing feel so much more possible. You know, think about learning to play the piano. You don't take one lesson and then suddenly you're playing at Carnegie Hall, right? Of course not. You practice and you get better and better and better. Investing is exactly the same. It is a skill you build over time. And this path right here just lays it out perfectly. Look, most of us start out at ignorance. Maybe we just hand our money over to someone else and hope for the best, without really getting how it works. Our entire goal here today is to move you from that first step to the second one, awareness. Just helping you see the field clearly so you can start that journey towards real competence and eventually proficiency. All right, so how do we build that skill? What we need is a solid, durable framework, something that gives us control in a market that, let's be honest, often feels completely chaotic. And this is where the 4 pillars of investing come into play. The main idea here is so simple, but it is incredibly powerful. Stop stressing about the things you have zero control over. You can't control a company's earnings report or what the market's going to do tomorrow. So instead, focus 100% of your energy on the things you can control, how you choose to position yourself, and critically, how you manage your risk. And here they are. These are the 4 pillars that give you that structure, that give you that control. We've got fundamental analysis, technical analysis, cash flow, and risk management. So, pillar 1, fundamental analysis. This is all about doing your homework on a company's actual health. Think of it just like checking the foundation of a house before you buy it. You want to look at its earnings, its debt, who's running the place. You're making sure it's actually built on solid ground. Then you've got pillar 2, technical analysis. Now, this looks beyond just one company and at the market as a whole. When you study price charts and trading volume, you're really studying investor psychology. You're seeing fear and greed play out in real time. This doesn't tell you what to buy, but it gives you huge clues about when might be a smart time to make a move. Pillar 3 is all about cash flow. And this, to me, is where things get really cool. Because with the right strategies, you can actually set yourself up to generate income no matter what the market is doing. Whether it's going up, down, or just moving sideways, you can still create cash flow. And finally, we have what is maybe the most important pillar of all, risk management. This is not about crossing your fingers and hoping for the best. It's about proactive protection. It's about having your umbrella with you before it starts to pour, not trying to find shelter when you're already soaked. Okay, now let's talk about a specific strategy that really separates the pros from the amateurs. This is all about putting that 4th pillar, risk management, into action in a really powerful way. Most of us are told to diversify. And for many people, that just means buying a bunch of different stocks and kind of hoping that some of them go up. But pros think about risk differently. They use a strategy called hedging. It's way more precise, it's less about hope, and more about strategically insuring your investments. So, what in the world is hedging? It's really just like buying an insurance policy. That's the perfect analogy. You spend a small known amount of money to protect a much larger asset from a potential loss. You're basically deciding your maximum risk right from the start. Let me give you a really clear example. Let's say you're worried that the Dow Jones Index, that's the one with the ticker symbol DIA, is about to drop. Instead of selling off all your stocks in a panic, you could use a tool called an inverse ETF. A common one is known by the ticker DOG. Now, this thing is specifically designed to move in the opposite direction of the market. So if the DIA index drops 1%, the DOG is designed to go up by 1%, which helps cancel out your losses. It's a direct hedge. So look, we've talked about the problem, we've talked about the mindset shift, the 4-pillar framework, and even a pro-level strategy. The only thing left to do now is to actually turn all this knowledge into action. And really, this is the mindset you want to have. The world is always changing. That's the one guarantee. You can either dread that change, or you can see it as an opportunity. When you build up your financial intelligence, you can start to welcome change because you know you have the tools to handle whatever comes your way. So I'm just going to leave you with this one question to think about. After hearing all this, after seeing the framework, what is the very first, maybe even the smallest step you're going to take to move yourself from awareness into real action?